in partnership with the Urban League. And we want to thank Michael and his staff, and particularly Brian Williams, the COO, for supporting this program. Tonight, we're going to be doing a recap, if you will, of some of the things that we've covered this year. And while we're doing that recap and touching on those things, I just want you guys to know that following the recap will be an exciting program delivered by some of the brightest young minds we have here in Los Angeles. But BWARP started because Michael and I were having a conversation and we saw what was going on in our community through gentrification, the lack of businesses sustaining themselves, and the number of homes that were being sold and lost to the legacy wealth of the neighborhood that we nurtured and grew. So that's why this program started, and that's why we're here this evening. So I just want to review the 2021 programs that we had at BWARP, which were presented by our panel. The very first program, Building Black Wealth in a White Economy, was a presentation that I made. The second program that we had was Wellness and Wealth by Dr. Zuri Morel, who's the chief of colorectal surgery at Cedars-Sinai, and Dr. Gloria Moreau, who's one of the finest psychologists we have here in the Southern California area. Our third presentation was Foundation Built on Home and Business Ownership, which was delivered by Daryl Brown, who is Senior Vice President of US Bank, retired, and David Murphy, EA, and he's also a real estate broker, as well as being licensed to represent us in front of the IRS. I Will, If You Trust Me, featured attorney Caprice Collins, as well as BJ Hawkins, PhD. And then that was followed by Invest Well and Live Well with Mr. Joe Haywood, financial planner, and Justin Lacy, wealth manager, who will be speaking with us later this evening. All of these presentations can be seen, if you missed any of them, just by logging on to laul.org/BWARP on the Urban League site. And I also invite you to visit parksideedc.org to find out more about Parkside EDC and the things we've been doing for the last 20 years in the Leimert Park area, giving away scholarships to young, bright African-American and Hispanic children, as well as teaching them financial literacy to prepare them for life. We all know the great work that the Urban League has been doing for the last century. They're celebrating their centennial, and we applaud them for the next centennial that'll be filled with even greater work. So Building Black Wealth in a White Economy. The reason we're doing this is because the median white household income is $188,000, where the median Black household wealth was $24,000. And when we use the word wealth, we're talking about what we own versus what we owe. Black wealth in a white economy. We often speak of all the disadvantages that we've had as African Americans in this country, starting with forced servitude, having no protection under the law. We couldn't even testify against someone if they did us wrong. We had no civil rights, limited human rights, and no land. And no land or resources. We didn't get our 40 acres and a mule. And that's what initiated this tremendous wealth gap and disparity that we're dealing with.
Reverend Gerald, don't forget to share your presentation.
I haven't hit share screen?
No.
Uh-oh. I'm sorry, I thought I had done that. So here's where I was. I apologize. I thought I had shared the screen, everybody. So what I was going to say was all of that we faced throughout our history in this country, it doesn't mean that we've done more things wrong than everybody else. It just means that we've experienced more wrong than everybody else. So building Black wealth in a white economy, there's something we can do about it. We know what's happened to us, but what can we do going forward to narrow the wealth gap? First, we have to be willing. We have to be willing to think and speak and behave differently, individually and as a community. We have to be engaged. We have to stay abreast of the market trends and collaborate with one another on opportunities. We have to be assertive. Let someone else tell us no. Keep our dreams alive and keep pushing until we achieve our goals. We have to be logical, analyze the circumstances, and make rational, not emotional decisions. And again, with programs like we're doing now, we have to be teachable, open to learn and apply new strategies. And most importantly, we have to work hard, be consistent, and make a diligent effort towards the goals that we're trying to attain. Our second presentation, Wellness and Wealth, would feature Dr. Zuri Morel and Dr. Gloria Moreau. We all know that in our community, we have the higher incidence of high blood pressure, diabetes, and stroke. And because we're more likely to be faced with these diseases, it's very important that we stay healthy on our way to building wealth. Dr. Zuri Morel shared with us that the more money you have, actually the healthier you are. Statistics show people with money have a lower mortality rate, a higher life expectancy, slower decline in physical function. They have a decrease in risk of obesity. They don't smoke as much, not as much hypertension or asthma. Physical wellness involves being aware and taking care of your body, eating right, seeing your doctor regularly, getting plenty of rest and plenty of sleep, and staying free of tobacco. Then Dr. Gloria stepped in and told us the importance of positive thinking, making good decisions, limiting the need to self-medicate, and allow one to maintain and enjoy his own wealth and help others once you attain that wealth is one of the things that she stressed. The impact of poor mental health on building wealth. One of the things that she said we needed to do as a community was recognize and talk about the issues that we have, not to let the stigma of mental illness keep us from letting people know and addressing our depression, our anxiety, and the problems that we may have. And she also says that when we don't address those mental health problems, it makes a negative influence on the community, and it results in the homelessness and poverty and unemployment that we face today. Mental wealth barriers, wealth bashing. There's no need in getting mad at the people who do have the wealth. We just need to do what we need to do to acquire it for ourselves and not be in fear of being successful and not associating everything that we do with poverty and having a lack of discipline and then getting burned out when things don't go our way. She left us with this saying, which I really like. It says, human beings have the remarkable ability to turn nothing into something, and they turn their needs, they turn weeds into gardens and pennies into fortunes. Then Mr. Darrell Brown came and taught us the rules of money. He said, pay yourself first, learn how to invest, give every dollar a job, spend less than you earn, have a plan, set goals, and keep your finances organized. He said, always have an emergency fund. Figure out how to make money work for you and learn how to make money work passively. Use it to solve problems and use it to help the situations in our world. And he says, don't use credit if you don't have the cash to pay that bill when it comes in. And if you want to make it, please make sure that you make more, I should say, more than you make. And he gave us this saying, if you save $27 a day, you'll be able to save $10,000 a year. David Murphy from E.L. Murphy and Associates told us that the more you own, the less taxes you pay, with a caveat. And he gave us the benefits of ownership and keeping property in the estate versus selling it and moving on. He said, you minimize your taxable income is the key to accumulating wealth. Income, gross income, adjusted income, and modified adjusted gross incomes are the different types that he took the time to explain to us and how to use them. And then he told us taxable income is key. Meet with your tax professional and have a plan to lower your taxes so you can get larger refunds. BJ Hawkins, one of our presenters, is a certified licensed professional fiduciary. And she wanted to let everybody know that when you don't plan properly and something happens and there's a dispute, you need to call on a professional fiduciary to step in and solve that dispute between the family, because those are the people who are trained, and BJ knows what she's talking about. She was the first African-American fiduciary in California and has to adhere to all the ethical requirements that the state authorizes in order to solve the issues of estates when someone passes or there is a family who can't get together and figure it out on their own. Caprice Collins, Attorney Collins, came and presented these facts with us about making sure that we have a living trust. And she gave us these Black wealth facts. She says that we're 12 to 13% of the population, but we only maintain 2.6% of the nation's wealth. And the reason is simple: the procrastination, not taking the necessary steps to protect our wealth. And she said the number 2 reason is we don't know what we don't know. So instead of going to LegalZoom and trying to get it done, it's best to get a professional who makes their living putting together trust for people and make sure they give you the proper estate planning, puts a trust together for you that not just for when you pass, but when you may be disabled and have special needs, and that'll keep you out of probate, keep the wills from being contested. And also she wanted you to make sure that you have long-term care. Mr. Joe Haywood, financial planner, covered some ground, and he's talked about setting goals, budgeting, having an emergency fund, making sure that you have the proper insurance coverage. He talked about using credit properly, investing, tax planning, and saving for college, as well as retirement planning, along with the big picture, which is your estate planning. And he asked you, how smart are your goals? How specific are they? How measurable are they? How attainable are they? How relevant are they? And how timely are they? They must be specific. They must be measurable. Don't set a goal that you can't attain. Make sure it's something you can attain. Make sure that it's relevant, and make sure that it's timely. And above all, write it down and prioritize your goals. The young man we're going to hear from in just a few minutes, Justin Lacy, shared investment fundamentals and risk tolerance, the ability to invest and plan to absorb loss, the personal tolerance for risk, which could be aggressive, moderate, or conservative. And he also talked about investment options, cash alternatives, bonds, stocks, alternative investments, and funds. And he made some people think that 401ks and IRAs are investments, but they aren't investments, but they are tax advantage vehicles that hold the investments that you make. So now we're getting ready to hear from, again, 3 of the sharpest young business minds we have in Los Angeles. Mr. Justin B. Lacy, who is Vice President and Resident Director of Wealth Management at Merrill Lynch. He focuses on working with executive business owners and families in designating strategies to help them enhance, preserve, and transition their wealth. Justin is a graduate magna cum laude from the University of Southern California, where he had a double major in business administration and accounting. Following Justin, or along with Justin, I should say, is Catherine Shirley, who is a seasoned CPA with over 30 years of experience. She worked for the big corporation KPMG before starting her own boutique business management firm, World Management Solutions, Inc. Catherine holds a bachelor's degree in accounting from San Diego State University and a master's degree in business of taxation from the University of Southern California. A lot of SC folks in the house tonight. And then we have Kevin Bryce Jackson, Esquire. Attorney Jackson represents fiduciaries and individuals throughout California in a wide range of trust and estate matters. Kevin graduated magna cum laude from California State University at Long Beach, and he obtained his law degree from the University of San Francisco Law School where he received academic honors during his time. So now I'm going to turn it over to Jacinda Moten, our producer, to introduce our guests and get started with today's program.
Hello, everyone. My name is Jacinda Moten, and I am the virtual producer of tonight's event. We will now begin our formal Q&A presentation. Now, afterwards, we will have an audience Q&A, so if you have any questions, please be sure to put them in the chat. So our first question is for Justin. Can you explain the process and the importance of setting financial goals and budgeting?
Yeah, thank you, Reverend Gerald. Thank you, Jacinda. I'll start with, first of all, super happy to be here. Happy to be able to share some strategies and provide some advice to folks here. Congratulate all of you guys for showing up, right? I mean, as Reverend Gerald mentioned before, the first step in terms of wealth attainment and, being in a good place financially and having all your ducks in a row is the ability and want to learn, right? And to be able to tap into programs like this, to be able to hear about what more you can be doing to best position yourself. So thank you guys all for coming out and wanting to educate yourselves. And just additional background about myself. I have a dual role here at Merrill Lynch. I work at Merrill Lynch down in Newport Beach. I'm an advisor, which means I help people make better financial decisions and help them maximize their financial potential. And then I'm also the director of the Newport Beach office. So I appreciate that role as well, as it gives me a position to be able to have a seat at the table in terms of how Merrill Lynch is operating, and allows me to be able to bring in new clients, new advisors into the firm to help diversify the ranks and have more people that look like us be financial providers and financial advisors for our communities out there. So once again, super happy to be here. So your question, Jacinda, was again, run it by me one more time.
Can you explain the process and the importance of setting financial goals and budgeting?
Yeah. So, in terms of, invest, people think of, people ask me all the time, like, hey, Justin, what should I invest in, right? And number one answer, the answer that I always say immediately is it depends, right? It depends on someone's individual circumstance. It depends on their financial goals. And the reason why it depends on the financial goals is, right, it depends on, if I have someone that's trying to pave a way to pay for their kids' college in 15 years, right? The investment process and the investment strategies I'm going to recommend are a whole lot different than if I have someone that's looking to buy a house in the next 5 years, right? The times that money can be able to work and stay invested change what we should invest in. The goal of the way that those funds are going to be utilized, whether it be for education, a new home, retirement, that changes the way that they're going to invest. So the first step of really having a solid investment plan and be able to do this thing right is to clearly understand and map out what your short-term goals are, what your long-term goals are, what the causes of them, what the values of them are, what the dollar amounts are of them. And that gets you the first setting of the first footing in terms of kind of being able to develop an investment plan. And then from a budget standpoint, as Reverend Gerald mentioned before, it's not about what you make, it's about what you keep. And I'm gonna take a step deeper. It's about not only what you save, but also what you invest. And now you may say, hey, Justin, save and invest, aren't those the same thing? No, I think about them differently, right? What you save is the money that's underneath your pillow. It's in your bank checking account. It's in your bank savings account. It's earning 0%, but it's okay it's earning 0% because you know that if you need that money tomorrow, you got it. You know to find it, you can easily pull it, right? That's what you save. What you invest is what you're putting into your 401k, in your IRA, in your investment account that you're putting in stocks, bonds, mutual funds, cryptocurrency, digital assets, whatever it is, that has a propensity and the ability to grow over time. And that's going to be able to grow for you over time, keep in pace with inflation, and be something that you can be able to utilize in the future for all your future goals. So I'll stop there, Jacinda.
Sounds good. Sounds good. Our next question will be for Catherine. But before I pose the question, Catherine, you can introduce yourself.
Sure, absolutely. Thank you all so much for having me tonight. I'm so excited to be able to speak with this group and talk a little bit more about taxes as it relates to millennials. And I know we do have some older or more seasoned individuals out there in the audience as well. So we'll definitely speak to those points as well. As Gerald already mentioned, I own a business management company. I'm the president and CEO. I have many clients in the entertainment industry, whether it's professional athletes, football players, Olympians. I also work with regular people like accountants, professors, doctors, lawyers. And so we have a really balanced clientele, and it makes it nice because I get to talk about and do many different things. So that's kind of a little short snippet about me.
Sounds good. So our question is, at what point should tax planning start?
Okay, so tax planning starts from day one, regardless of what it is that you're interested in doing. And really just to kind of talk about planning just in general, we all plan for different aspects of our life. When you're in high school, you're planning for college. When you're in college, you're planning for the workforce. And so tax planning is just the same as that. As soon as you're interested in starting a business, you have to speak with someone about planning to make sure that you are getting all of your ducks in the row. And also one of the biggest things is that with tax planning, you get things done properly the first time. What's difficult for CPAs, enrolled agents, tax preparers is if someone does something and we have to try to undo it, and that makes it very, very difficult. And so to answer your question, definitely day one is just like planning for any other aspect of your life.
Yes, planning is key. And our next question will be for Kevin. And before I pose the next question, Kevin, you can introduce yourself.
Yeah, sure. So good evening, everybody. I'm Kevin Jackson, as you already heard. I'm a trust estates attorney here in California. And so essentially what I do is I help my clients preserve and transfer their assets to the next generation. And you do that through estate planning. I also handle administrations and litigated matters after the fact. So when I'm drafting my plans, it's not just theoretical to me. I've actually been through the practical process, and that really does help my clients out. And so really, I'm excited to speak today because the concept of generational wealth has been a really hot topic nowadays. What I always say when I speak to people is you're not building generational wealth unless you're properly passing your wealth to the next generation. And so I'm really excited to speak with the Urban League and BWARC. And I'm just basically going to answer some questions today about estate planning and financial literacy. And you can really see this organic shift in our community, especially towards wealth building. So, feeding that interest with exposure to these fundamental concepts is really key. You really can't help yourself if you don't know what you don't know. So my goal today is to at least help you find out what you may not know, and then you can choose how you'd like to proceed from there. So thank you.
Sounds good. So the question that we have is, at what point should a person prepare an estate plan? And what are the basic components of an estate plan?
Okay, sure, yeah. So I have to do this. So before I answer the question, I'm going to give you a disclaimer, which probably fuels the stereotype for attorneys, but I have to make this clear. So basically when I'm speaking today, I'm going to speak in generalities. What I say isn't intended to be, is just supposed to be a general overview and discussion of the subjects. I can't go into anyone's specific circumstances, and this is not legal advice from me to you. So basically me discussing this today doesn't create a lawyer-client relationship. And so you definitely want to consult your own attorney individually on a one-on-one basis. And also what I'm going to discuss is basically just California law. So if you're in a different jurisdiction, you're definitely going to want to meet with an attorney in your state. Okay, sorry about the disclaimer. Attorneys have to do it. Now, the question was, and I remember, at what point should a person prepare an estate plan, and what are the basic components? So to the first question, every adult in California, regardless of their financial status, should have an estate plan. And the reason I say such an early age, which is 18, is estate planning isn't just about your assets. It's about your person as well. And your person means your ability to make decisions for yourself and potentially for your children if something happens to you. So for example, choosing where you're going to live, making medical decisions. If you have literally no assets, you still have to plan for that scenario where you can't make those decisions for yourself. So I just moved back to LA. That's where I'm from originally. Well, I was practicing in the Bay Area for quite some time. I taught estate planning at USF Law School. And this is what I taught my students, the 3 phases of planning. You have life, you have incapacity, and you have death. So just remember, keep that in your brain. And Justin and Catherine know all about that. So most people are going to skip straight to planning for their death in regards to their estate planning, and they forget that they have to plan for the scenario where they lose their cognitive capacity potentially. And they also can plan like during their lifetime when they're cognizant. So really what you're going to want to do is you have to have some form of an estate plan if you're an adult. Like I said, you have to plan for your life and your incapacity and your death, those 3 phases. So remember those because those are important. To the second question, what are the basic components of an estate plan? What does planning for your life, your incapacity, and your death look like? So there's really 3 components. So first, every person that's 18 years or older needs a healthcare power of attorney. And now here in California, we refer to those as an advanced healthcare directive. So in this document, you're going to have someone that you trust, a person who's called the principal. That's going to be you. You're going to name a fiduciary, someone you trust, who's going to act as your agent to act on your behalf, for your healthcare if you were to lose capacity. So that's planning for that second phase. So for example, the director is going to instruct whether to provide pain medication if you're sick, or whether to donate organs after death, or whether the person wants to continue to live in their home. And so also keep in mind, if you have children, you'll also want to nominate a guardian. Now, so advanced healthcare directive, that's the first part. The second part is for your finances when potentially losing capacity. So every person should have a power of attorney for their property. Now, this power of attorney is going to function similarly to the advanced healthcare directive, except it's going to be for your property in the event that you lose capacity. And now the third component, and this is what most people understand, is this is the more commonly known one. Everyone has to have some form of a distribution plan. And a distribution plan is going to direct how your assets are distributed after you pass away. So the most common instruments to pass your property are a trust and a will. Generally, you want to do a trust, but in some scenarios, a will can work. So remember, everyone's estate planning needs are unique, but all adults have to have one. And the main 3 components are that healthcare power of attorney, the financial power of attorney, and the distribution plan. So 2-part question, a little longer, sorry.
It's all good. All righty. So our next question is for Justin. What are the investment vehicles people should consider contributing to or for developing their wealth in the short and long term?
Yeah, so we're talking about traditional investments here, right? So where to hold your stocks, bonds, mutual funds, all that good stuff, right? But cryptocurrency as well. So if you work at a larger employer, you probably have a 401k that's offered through that employer. Definitely take advantage of that. Kathy can talk to you all about the tax savings that come from making contributions to a 401k. A lot of companies provide matches on a 401k contribution. So if you put in, $15,000, they may put in $8,000, $10,000. There is tax-free money, there's pre-tax money, but there is nothing better than free money, right? And an employer match is free money. So everyone check to make sure that if you participate in a 401k, check the 401k summary plan description, which includes all the information on the 401k, the employer match, and take advantage of that. Also, in some 401ks, you can actually do after-tax contributions, which means typically if you're under 50, you can only do $19,500 into a 401k. Some companies allow you to be able to put in an extra $20,000, $25,000 additional in after-tax contributions, which is a great way to add more to your retirement nest egg. So that's 401k. If you're own your own company or self-employed, there's a thing called SEP IRA, the SEP IRA. That's a great way to have pre-tax money go in and be able to invest in a whole array of investment options. Take advantage of that. If you're saving for like a kid's college, 529 plans are the premier college savings plan to be able to save. If you have a disabled kid, there's a 529C plan, I believe they're called ABLE plans, ABLE, and they're specifically for kids with special needs to make sure that they have money that can be able to grow tax deferred and doesn't impact your ability to qualify for federal support for having a kid with, with special needs. Then also you can have Robinhood got really, really big over time where people recognize that, hey, I don't need to have just a 401k or an IRA with just a retirement plan. I can set up just a regular brokerage account, throw some cash in there and select my own investments I think are going to have promise going forward and can be able to grow in time. So all those different investment vehicles are to offer, and really some of them depend on there's Roth IRAs as well, but a lot of them depend on some of them depend on your relationship status, your income limits, and some other factors. So it's good to talk to someone like a financial planner and potentially a tax person to be able to understand what are the different vehicles you can qualify for and you can contribute to, and then what does it make sense to contribute to this over this over this based off your own individual circumstance.
Awesome, sounds good. Our next question is for Catherine. How often should tax planning occur?
Definitely regularly. That's probably one of the most important things that I want to say. It needs to be consistent and it needs to be regular. I would say at least annually, but it really should happen as your life is happening, because things are happening throughout your life. Your families are growing and things change. You need to make sure that you're planning for each of those aspects. And so I'll just give you a couple of examples. It might be something just as simple as that you're going to have a lot of dental work done. And so if you are, fortunate and you have insurance, you can potentially sign up for a health savings account. And what you do is you put money into that account and it's tax-free, or pre-tax, I should say. And then once you have that money in there, when you have the surgery or whatever dental work you're going to do, you take that money out and you have that dental work done. But the benefit is you put that money into an account and it was, pre-tax. You didn't have to pay tax on that income. Another thing that you can do is, let's just say an example of tax planning is you have a family, you have children, and what do most parents want for their children? They want them to have a college education. And so you can use a 529 plan or other plans that Justin will probably be able to tell you more about. And when you put that money into that particular account, it grows tax-free. And so whatever money that it accumulates to, you can use that money to pay for college and you don't have to pay taxes on a gain. It can get even more complicated, where as an example, you have a rental property that eventually you want to sell. Well, if it's a rental property, you're going to pay capital gains on the entire from the gain, less whatever it costs, you purchased it, you're going to have to pay taxes on that. But what you can do instead, you can consider moving into that property, staying in it for at least 2 out of 5 years and turning it from a rental property into a primary residence. And there you can actually exclude $250,000 if you're an individual, or if you're married, up to $500,000 of gain, so that you can, again, kind of get rid of the taxes there. I think with planning, the one thing that you want to remember is that you're actually analyzing your financial situation to reduce your tax burden. And so if you are regularly doing that, regularly speaking with someone about that, as things change throughout your life, you're always going to be ahead of the game and making sure that you're structuring things properly. And like I said before, you want to make sure that you're not doing something and then after the fact you're having your CPA to kind of clean up things, because many of the things that you might jump the gun and do, it can be cleaned up. And what ends up happening is that you pay a lot of taxes on that because you didn't exercise, just some tax planning, just some simple tax planning.
Awesome. Our next question is for Kevin. What happens if you die without an estate plan? Kevin, your audio?
Okay. So this is the part that no one ever wants to talk about, of course, but it's really important. And even before I go there, if you were in my class, I would make you say it back to me, but I obviously can't hear the audience. But you have to drill down the concept of planning for your lifetime, planning for your incapacity, and planning for your death. So before I answer the question about what happens if you die without an estate plan, I want to explain what happens when you lose capacity without an estate plan. So if you lose capacity without an estate plan, meaning without the financial power of attorney and advanced healthcare directive, having some form of an agent, sometimes a conservatorship proceeding may be necessary. So what that is it's a court proceeding where someone who might not even want to be appointed.
Kevin, 1 second. Could you check your speaker? Your audio is choppy.
Can you hear me now?
We hear you, but it's muffled.
Is this better?
It's still muffled.
That's odd.
You may want to call in instead of having it go through the computer.
Is this better?
Much better.
Okay.
Thank you.
So yeah, all right, sorry about that. So where was I? So basically, this could, where was I? So yeah, so basically a conservatorship proceeding. So basically what that is a court proceeding where someone is appointed to manage your financial affairs and basically your daily life. Now, this results in, court supervision of essentially all aspects of your life. It can include annual reports concerning your finances, medical information, daily activities of living. It also can get very expensive because the conservator and the attorney get paid from your estate generally. And so, as adults in California, we really have to designate who we want to make decisions on our behalf in most scenarios. And if you don't have a proper estate plan, you're more likely to be subject to a conservatorship if you lose capacity, although sometimes you can avoid it, but an estate plan really might help you avoid it in certain scenarios. So that's important because those are the 3 phases. But now moving on to death, if you die without an estate plan, you subject yourself to another court proceeding and this, or at least your estate. And this proceeding is more commonly known. It's called what we call probate. So that's like one of those words that trigger words that everyone hears, but they don't necessarily know what it is. And so we talked about the Advanced Healthcare Directive and the power of attorney. And that third component is the distribution plan. So a lot of people might say that they think their property is going to go to the state without an estate plan, but that's not really true in most cases. If you die without some form of a distribution plan, your property is almost in every scenario will go to probate. I mean, there's certain assets that don't go there, but your property in your probate estate is going to be distributed according to the laws of intestacy. And so intestacy is basically the default distribution plan that California makes for you if you do not act for yourself. So if you don't choose your beneficiaries, California chooses your beneficiaries. And so, it's the basic people that you might think you want to get your assets, but I mentioned every person's situation is different. You have blended families, people have charitable wishes, adopted children, there's all different types of things. So without specifying exactly how you want your property to pass, probate, your property will go to probate, and the intestate disposition, could really have unwanted consequences. So.
All right, yes, choose your beneficiaries, very important. Next question is for Justin. How should we think about the amount of money to have in an emergency fund?
Yeah, sure. And I just want to quickly remind everyone that there is a Q&A box at the bottom. So feel free to fill in some Q&A questions, and we'll be able to refer to them once we're done with this structured part of the Q&A. In terms of how to think about emergency fund, I think about it really simply. 3 to 6 months of living expenses, keep that in cash. Have that as emergency fund. And I know you may be saying, hey, my monthly expenses are $5,000. You're talking about anywhere between $15,000 to $30,000, right? That's a goal to try to get to, right? I understand that may not be, possible as of now, but the reason why we advocate for this is because, one, unexpected expenses happen, right? It could be a leak in your house. It could be your car goes down. It could be you lose your job at the beginning of the pandemic. That, you know, that became into fruition for a lot of folks, right? So keeping that 3 to 6 months of living expense really just allows you to be able to have a buffer for unexpected expenses. And also too, it's great to be able to have some cash and access to some cash in case an unexpected investment opportunity comes up, whether it be a, you know, crazy deal on a duplex in Ohio, or, you know, there's a big stock crash or crypto crash, digital asset crash, and you feel like, hey, maybe now's a good time to get in when prices are down 70%, right? But between 3 to 6 months, I kind of keep that on the side. And then additionally, if you expect to have any major expenses, like you're about to buy a home, right? Or you're about to buy a new car, and that's going to be done in the next year or so, I'd keep that money in cash in addition to that 3 to 6 months, right? And the reason why I say that is because, you know, the shorter the time that you have to invest money and keep the money in the market, the more that it's gambling instead of investing, right? So since the stock market's been in play like 1920s, the probability of you putting money in the U.S. stock market and it being higher a day later is 50%. It's a coin flip, right? The probability you put money in one day and a year later it's higher, it's 75%. Probably you put money in today and 10 years later it's higher, that's 95%, right? So the longer you can have your money work for you, the more that you are, and I never like to use the word guaranteeing, but the more you are assuring that you're going to be able to make money on that. And you don't want to be in a situation where you and your spouse find the amazing house of your dreams, the $1 million, $200,000 for that down payment. You're going to buy it in 3 months. You're going to keep that $200,000 in stocks for the time being. And March of 2020 happens again where the stock market's down by 30%. Now you only have about $1.60 instead of $200 to make that down payment, and you can't do anymore. That's how divorces happen. That's how fights happen, right? So keep that money in cash that you know is going to be spent the next 6 months to 12 months for major expenses, and also have that 3 to 6 months living expenses in cash as well, if you can. And that's not something that, if you don't have it right now, it's perfectly fine. But what I would recommend is a portion of your discretionary income each month, which means that if you bring in $5,000 and you have $4,000 of expenses, $1,000 a month is your discretionary income. So a portion of that discretionary income, I would automatically save that to a savings account. Like what I did to build up my savings fund is every single month I did auto transfers from my checking account that receives my paycheck over to my emergency fund. And I moved a certain amount every single 2 weeks, like clockwork, put it into motion, didn't have to worry about actually doing it myself. And it was so easy because it automatically took place. And I never wanted to take money from this savings account because it said, hey, Justin, serving a savings account, emergency savings account. So I would feel really bad taking that money out and putting it on red 3 and roulette, right? Or taking it or buying, alcohol, whatever it is, right? So make your life easier and do those type of like psychological, shortcuts for you to be able to make your savings and your investing plan a whole lot easier.
Yes, save, save, save. You cannot depend on the GoFundMe. Save, save, save. All righty. Next question is for Catherine. Should tax planning be done solely with the CPA?
So definitely not. And the group that we have here is perfect. You have a financial planner, you have a estate attorney here. Working in conjunctions with other people really makes it better for you for tax planning. Justin was just talking about, budgeting excess money. If you're doing tax planning, you'll have that excess money so that you can save and have the things that you need for when that rainy day comes up, or if you're saving for something. And so, at the very least, because I don't want to make it seem that everyone has the ability to afford a financial planner, an estate attorney, a CPA, a tax expert, or whatever it might be. But if you just work with your tax preparer, that person can really help you get on the right foot and do the right things again ahead of the time. But let me just kind of talk about what we're doing anyway, and kind of just a strategy for tax planning. Justin talked about retirement. So with tax planning, you're trying to defer reporting income or having to recognize that income. And when you're putting money in retirement, you're able to defer that. Also, you want to increase different opportunities to have tax exempt interest. You also want to do everything that you can to maximize deductions and tax credits. And so basically whenever you're in business, anything that's ordinary and necessary for that business, you can write it off. And I say ordinary and necessary, those things are really key because, just because you're going out and having lunch with someone doesn't necessarily make it an ordinary and necessary business expense. But you want to make sure anything that you do as far as trying to earn money for whatever the business is that you have, that you're properly tracking those expenses, because the IRS is going to make sure that you have some type of substantiation for that. But, again, working with other people and having really a group or of trusted advisors to make sure that you're doing the right thing is going to be key. And again, I know that sometimes there are costs associated with it, and so you can't do everything. But, taking courses like this or sitting in on webinars and kind of hearing what people are talking about. Kevin is right. We're not giving legal advice. I'm not giving tax advice, but I'm giving you some education and some place for you to be able to go and get more information and figure out some things that you need to do. And I also should just talk about the fact that there's more than just income taxes. Whenever we're talking about taxes, we tend to think about income taxes and maybe personal income taxes, but there's also corporate income taxes. There's property taxes, there are capital gains, there's sales taxes. There was one of our billionaire Americans, they were talking about their wealth and not having to pay a lot of taxes. And they were being interviewed, and the person asked, well, would you care if they increased our taxes to what the taxes are in France, as an example? And he had to explain to them that he didn't care because he's not making ordinary income taxes. He makes his money off of capital gains when he's selling stock. And so those tax rates are going to be much lower. And so really getting an understanding and talking with different people will help you do better for tax planning as well.
Yes, yes. And our next question is for Kevin. What is probate and why do you want to avoid it?
Okay, and can you hear me well?
Yes.
Good,
Mhm.
okay. Probate, okay, so probate, so basically in a probate proceeding, it's what happens when you pass away, like I mentioned earlier, without any type of a plan, or if you just have a will. It's basically a court process. And so the court basically appoints a personal representative to handle the probate estate, or if you have a will and you name someone, that person will act as your executor. So that person gathers and inventories the decedent's assets. They alert all the known creditors, they pay the creditors if warranted. They account for the assets of the decedent, and then they take the property and transfer it to the heirs or the beneficiaries of that decedent. But that's after they petition the court and provide an accounting to the court and get approval to do that. So it's basically all court supervised, all of the actions. And there's a lot of downsides to probate. One of the big things is it's slow. Like many court processes, is pretty slow. Oftentimes it could take a year to transfer the assets or go through the whole process, depending on which county you're in. I've had probates that took multiple years due to unique circumstances. Another downside is it's public. So the deceased person's assets and business is going to be put on display in the public court record, and basically all aspects of the administration are going to be reported. So you'll have all of that public information out. And one of the big things are, I think Reverend Gerald mentioned, just the wealth retention and the wealth gap. It's expensive. So, millions of dollars in fees and court costs are lost every year to probate in California. It gets pretty expensive. You pay the personal representative, their attorney. You pay them statutory fees, which is like basically a formula based on the gross estate of the estate. So if you don't have equity, but you have like a house, it's paid on that higher amount. And also you have the court costs, and then there's also what's called extraordinary fees on top of those statutory fees that she'll end up paying. And that could be like for selling the house. So you get the statutory fee, then the attorney and the personal representative can bill hourly for selling the house or doing other extraordinary things depending on the court. So those are just some reasons the person would want to avoid probate, and you do that by executing or putting your assets into a trust and other estate planning vehicles. But some clients decide that they want their property to go to probate. Few do, but some do. And they say because it's court supervised and that, that's their call to make. But the goal is to make sure that they know what they don't know and they're making the informed decision to do so.
All righty. Our next question is for Justin. What is the importance of debt management, and what are some strategies we can utilize to better manage our debt?
Yeah, so debt management is so important, and your credit score is super important, right? You having a 700 credit score compared to you having a 640 credit score, makes tens of thousands, if not hundreds of thousands of dollars of difference in interest if you buy a home, right? Especially these mortgages in Los Angeles that are, over $600,000. So, every bit that your credit score increases, the less you're going to pay in interest in cars and mortgages and so many other things. So it's super important to be able to do so. If your credit score is below a certain level, you're not even able to get access to certain credit like mortgages and cars, things of that sort. So that's really important. Now, how can you be able to better develop your credit score and utilize debt management? There's a couple, ways to go about doing so, but really you should really, print out or create a spreadsheet of all different debt that you have, if you do have debt, and rank it, show the amount that you have, show the interest rate that they had, and maybe even consult with a tax person to see if the interest you're paying for it is tax deductible. And that will help you better understand what's the most, efficient and productive debt for you to eliminate. And then just go at it in terms of trying to find a way to quickly eliminate as much as possible. Paying, if you have credit cards, those typically have the highest interest rates out there. Try your hardest to not have credit card debt. There's no reason for you to be paying 20, 25% to these credit card companies to carry on balances, right? The minimum payment each month is not the payment you should be doing. You should try to be paying it off each month. And that way you're able to get all the cash rewards and all the benefits that come with utilizing a credit card, but aren't being, hit by the large interest that you're being incurred, or that you're being accrued, if you continue to have that balance each month. So that's probably that's kind of the straightforward approach. But from a psychological standpoint, like I said, one way to think about doing it is pay it off by the highest interest rate possible. But some people benefit by just ranking all their debt out there, and if they kind of feel like they're overwhelmed, start with the debt that has the lowest balance. And sometimes just from a psychological standpoint, it feels a whole lot better to just completely pay off some debt, even if it's a little bit lower interest rate, to know that, hey, I used to owe 6 people, now I only owe 5. I used to owe 5 people, now I only know 4, right? But figure out a process from a financial standpoint and emotional standpoint that makes sense for you, and just go about trying to do it, because having a good credit score and limiting your debt and really maximizing your debt management is so important for you to be able to maintain to be able to create as well as maintain wealth.
Yes, try to avoid those interest rates. It's not pretty. All righty, I love this question. Catherine, does the tax structure my business uses matter?
It absolutely does. And I'll just talk about a few structures that are available for small business owners. There's a sole proprietorship, there's a single member LLC, there's multi-member LLCs, there's S corporations, C corporations. With all the different structures that are available, there's some considerations that you have to have. One is the ease of formation. And for most people, they want to go with the one that is easiest to form, and usually the one that's least expensive to form. And so cost is definitely going to be a consideration, and not only to create the entity or the business, but also the cost to maintain it. You have to get it set up. You have to pay an accountant or have accounting done. You have tax returns that you have to do. And those are payroll tax returns, income tax returns, might be sales and use tax returns, depending on what it is that you're doing. You also have to consider liability protection. Are you going to be personally liable for the business debt that's there? Also, you have to consider whether or not you can get business loans or capital or build credit. And so that's going to dictate the type of entity that you have. You also have to think, how am I going to get money out of this corporation if you do set up another corporation? And I'll go into those a little bit more in detail. Also, where's the tax imposed? Is it imposed at the corporate level or partner level, or is it down at the partnership or individual level? And then also, you know, when you come to the time where you just don't want to do business anymore, what is it going to take to dissolve the particular entity? And so just in general, as I mentioned, the sole proprietorship is the easiest way of doing business because you don't have to go out and set up a separate legal entity. You can operate just as you are. Many people end up getting a DBA where they're doing business as another name. So they're not just using their name, but essentially they get a bank account and make sure that they run all of their income and expenses through that business account. And as long as they're doing proper accounting, keeping good books and records, then they're fine as they are. Typically what happens is that the information from your business is included on your tax return on a Schedule C. And so all the income and expenses, they're reported there. There's no separate entity tax return that has to be done. So that's one. Another one that's very popular is a single member LLC. Same thing, you need to make sure that you have a separate bank account. You actually do have to form a separate legal entity, but a single member LLC, it's considered disregarded for federal tax purposes. And so you don't actually have to file a separate federal tax return for that entity. The information is included on a Schedule C, just as if you were a sole proprietorship. But you do actually in California have to file a separate tax return for that particular business entity. And so there's some extra that has to be done there. There's also multi-member LLCs or partnerships where you have more than one member, and those get a little more complicated because those are definitely separate legal entities. You have a separate federal return, a separate state tax return, in addition to your individual federal and state tax return. And then there's S corporations. A lot of business owners, once they get a little more complicated, they operate under S corporations. That also is a pass-through entity. It is a separate legal entity that you have to set up and have, a different bank account and making sure that you're handling the accounting and everything properly. With an S corporation, in order to get money out of that particular entity, you have to pay yourself a salary, and that salary has to be reasonable. And the IRS really pays attention to that because unlike a sole proprietorship or a single member LLC, when you want to take money out of that particular company, you can just go to the bank and take the money out. But with an S corporation, you have three ways. You can pay yourself as a salary. There are instances where you might have to take a loan from the corporation, or you can take a draw. But again, your salary has to be reasonable. The draw that you take from your business can't be more than the salary. And the IRS will actually come in and recharacterize a draw and say that it's wages, and really hit you with some harsh penalties because they think that you're evading payroll taxes. A C corporation, really small businesses don't usually go that route because what ends up happening is that there's double taxation. And so you pay taxes at the corporate level, and then you also pay taxes as you take the money as a dividend. And so that structure isn't one that's usually common among small business owners, but of course it definitely is available.
Great insight, great insight. Well, that concludes the formal presentation for our Q&A. We have a lot of questions rolling in. And our first question from the audience is, I am in my early 30s and building a real estate portfolio. What are some tips for planning my estate, especially if I don't have children later in life?
I guess that's for me, right? So again, like I mentioned before, and like Justin answered earlier, it depends, right? It depends on what you want, but you definitely need to do a plan. I generally say, as far as if you're in California, generally I recommend a trust. Especially if you have real property or if you have children, that's generally when you want to do that. But really, it's going to depend on your financial makeup, and then also what your testamentary wishes are. Testamentary means who you want to pass your assets to. So it really just does depend. But the best advice I would give you, not legal advice, just a suggestion, is to definitely do an estate plan and meet with an attorney to help you do that.
All righty. We have another question from an audience member. What investing advice should I watch out for? What would steer me in the wrong direction?
Yeah, I'll take that one. I'd say, watch out for individuals that tell you, hey, invest in something because it works well for me, right? You need to do your own, almost sound like the vaccine conversation. You need to do your own research on investments and choose choose investments, right, based off of, things that you find attractive about it, right? Warren Buffett, I'm blanking on his name right now, but a lot of great investment professionals have always said that there's no such thing as a great investment. There's good investments at great prices, right? So like Apple could be a phenomenal company, but priced at $200, Apple could be a great investment. Apple could also be a great company, but priced at $500 is a terrible investment, right? So just because someone made money investing in this digital asset or something like this a year ago, doesn't mean that if you put that money in December 16th, you're gonna see the same level of returns as well. So you really got to do your own research, kind of figure out why you're investing in something. And my advice is, never put too many eggs in one basket. Stay diversified. Don't put all, spread your investments around, and don't get too trapped up into what any one person is telling you about success they had in the past.
Yes, do your research. Next question is for Kevin. What is the difference between a trust and a will?
That's the famous question. All right, so I have to go back to my mantra, the three phases, because it's really the foundation of your estate planning. So remember, life, incapacity, and death, right? That's what you want to plan for. And so let's talk about a will. So a will is a document that directs to whom and how you want your assets to be distributed. But a will only takes effect on your death. So again, if you were to lose capacity during your lifetime, the will won't help you. A will is also subject to probate. So there's a bit of a misconception amongst people. If you have a will, you'll avoid probate because that's an estate plan. That's not true. If you die without an estate plan, you're going to be subject to probate and the intestacy, that default distribution scheme of California. But if you die with a will, you're still subject to probate, but your disposition plan is distributed according to the will, but still through the probate process, right? So that's a will. But a trust is different. A trust is a document that essentially holds your assets. And except for like an IRA, you don't put a 401k in a trust or anything like that, but your real property, your investment accounts, et cetera. And that trust governs the management, use, and disposition of those assets. And so one of the best parts about a trust is that it plans for all three phases, like I love, life, incapacity, and death. And because that trust takes effect immediately upon its execution. So once you execute the trust, your assets are protected by the trust and included in the trust during your lifetime. So if you lost capacity, the trustee of your trust is able to control the assets in your trust. So, so basically, that's kind of like the summary answer. But again, you definitely want to consult with an attorney to discuss, what works best for you. But the trust definitely helps you skip probate.
All righty. Very interesting question that I have here. For someone just starting their career in their early 20s, what percentage of their retirement contribution should go into the Roth option if that is available? What are the pros and cons of Roth versus regular retirement pre-tax account?
You want to do that, Kathy, or do you want me to do it?
I'll talk just about that little Roth piece, because with the Roth IRA, you're actually putting in after-tax dollars. So when you get the distribution, they're tax-free, as opposed to a traditional IRA, you put the money in pre-tax. And then when when the money is distributed to you, you actually are going to pay taxes on that distribution. So many times people want to choose that Roth because, as you know, once they get into the retirement age, they don't want to have to deal with tax implications. But that's kind of generally, as from a tax standpoint, the difference. And then Justin, you can go ahead.
Yeah, and typically if you're younger and you have and you're not making that much income and you're in a lower tax bracket, right? If you're only at like a 20% tax bracket now, right, and you expect in retirement years you be in a much higher tax bracket, call it like 25, 30%, then it makes way more sense to not get a tax deduction now at the 18% tax bracket, and then bring that money out tax free in retirement years when you'll be at a higher tax bracket. So I always recommend having a combination of both pre-tax money in the traditional 401k as well as after-tax money in the Roth 401k, because that allows you optionality and flexibility in your retirement years to say, now I'm going to pull from my tax-free accounts in this year that my taxes are higher, or the government decided to make them higher. I'm going to pull from my after-tax money here, or in years when your income tax is lower, in certain years in retirement, then you pull from your pre-tax account where you're willing to pay taxes because your tax rate isn't as bad. So I would just recommend having a combination when you're young. When I was young, I did 50% Roth, 50% traditional. I think it worked out really well for me. So I'll probably do something similar to that. But as always, it depends.
All righty. Our next question is, what are your thoughts on buying financial literacy and investing courses instead of hiring an advisor?
Yeah. I don't think that everyone at all points in time needs a financial advisor. I think that there's a lot of education that you can get from these different resources. If someone wants to talk to you out, aside from this, I can give you some of the podcasts I listen to and articles I read. So I think you can really educate yourself. I would say, though, that I think we can all benefit by having a solid financial advisor within our network that we can run ideas off of. I have, a number of friends that reach out to me on an annual basis and say, hey, Justin, I kind of just have an annual checkup on some questions I have, like, what you got for me, right? And I'll help them out. And they know that, like, hey, like, if their assets get to a point in the future where it makes sense having a wealth management advisor not only help them going forward, but also preserve what they've now accumulated, they're going to become a client. But as of now, as they're just in that asset accumulation phase, don't need an advisor for the preservation of assets, where advisors really usually come into play. I can provide them that counsel right now, pro bono, and they can take me out for drinks or food as a payment. But yeah, and once again, I'll broaden this out to, like, we should all try to have, financial advisors, CPAs, real estate attorneys, estate planners, like doctors. Like, we should all try to have those people in our network, right? Because that's so valuable for us to be able to lean upon these people for this pro bono advice and this guidance. Because we need it. And the more that we learn, the more that we earn, and the more that we grow financially and health-wise. So, I encourage everyone to try to expand their network as much as possible with as many, different service professionals out there.
Yes, build a tribe of advisors. All righty. Next question is for Kevin. What ways can estate plan benefit me while I'm alive and well?
Okay, that means someone was listening. So life, incapacity, death, right? So they're talking about alive, you have your capacity. So, maybe what I'd say is I'll explain a trust a little bit more. And this is your basic living trust. There's living trust, and then there are, which are revocable, right? And then there are irrevocable trusts where you transfer assets to a trust and then you divest ownership of them. They go into a trust that can't be revoked. So just with that caveat, there's basically three main players with the trust when you have a trust asset. When you have a trust, you have a settlor, a trustee, and a beneficiary. So the settlor is the person who's going to contribute the assets to the trust. With the revocable trust, the settlor is the beneficial owner. They create the trust. The trustee is the legal owner of the assets that are inside of the trust. So The trustee owns legal title to all of the assets that are placed in the trust, like your house, like the real property or something like that. The trust is going to have the trustee is going to have the ability to sell the real property, manage bank accounts, make investment decisions, things of that nature. The beneficiary is the person who benefits from the trust. So with that in mind, and it's not as complicated because generally when you create your initial revocable trust, you're the settlor, the trustee, and the beneficiary. And that will then, the trustee, that will then change if you lose capacity, and then the trustee and beneficiary will change when you pass away. But basically, so sorry to give that backdrop, but I think that's important. But basically to answer the question is, when you're alive and well, a trust can benefit you because you can't plan after the fact. So if you lose capacity or if you die, you can't then somehow create your trust. So while you're alive and well, you have to put these plans in place, because a plan basically dictates what happens at a certain event, which would be the capacity and which would be the debt. So that's one thing. Another thing is, when you're alive and well, you could name someone else as the trustee. Say you have your capacity. Sometimes say you have your capacity, but you're maybe older or you don't want to deal with your assets. A lot of the times people will put one of their children as a co-trustee to help mom or dad manage their assets, you know. So that's another thing. Or just name the child as the trustee to manage those assets while they're alive and well, but they can't, you know, deal with all of the assets. And the last thing I would say is, while you're alive and well, you can use other trusts as basically tax saving vehicles, which is complicated and probably more high level than the discussion here, but basically to potentially avoid future estate tax. So you'll put your assets in an irrevocable trust to get it out of your estate, to lower how much you own, and that way you won't get taxed on death. So those are like the main concepts.
All righty. This question is for Justin. Someone recommended a secure credit card to help build your credit. If it is low, is that recommended?
I have no idea what a secure credit card is.
Okay.
Kathy, Kevin, if any of you know, feel free to jump in. I never heard of it before.
It's probably where they have to have money down to cover the credit card. If it's $500, they actually have to have the $500 with the institution, and they're basically using it to swipe. I don't know a whole lot about it and whether or not it helps to build credit. Sorry.
Oh yeah, I think that's like the Russell Simmons card, right? I think you got that.
Yes.
Right. But yeah, I don't know anything about it though.
I can comment on that. Yes, a lot of, I've had clients who we do loans also. And if they have bad credit, they may get 2 or 3 $500 cards, give them the money to the bank, use the cards at the 30%, go over 2 or 3 months and their credit will come up because they'll see the payments. So you can use that as a way of increasing your credit in a very short period of time, but you're really using your own money.
Righty. All right, our next question, again for Justin. Is there a basic order of operations when it comes to wealth building? First step, second step, etc.
Yeah, I got to pull out those ugly "it depends" statement again. But because right, like so let's look at scenario one, right? Scenario one for someone that's completely debt free, right? Or let's say someone that has $1,000 or $10,000 in a car debt, right? And the interest rate is 1%, right? I would say, hey, maximize your 401k, invest any additional discretionary income in an IRA account and then a brokerage account. Just save and invest as much as possible. Don't worry about paying off the debt because it's a 1% interest rate, which means that if the things that you invest in get higher than a 1% return, then it made more sense to invest in those things than to pay off that debt, right? But if you instead have a credit card debt of 25%, person got the same discretionary income, you ask me what should you do? I say, if you can guarantee that you can find investments that get higher than 25% return, then you should invest in them. Now, I don't know any investments that have a guaranteed 25% return. So what I would do and what I would advocate someone to do to knock out that credit card debt until that's paid off. And then once that's done, then start being able to save in those different vehicles. So you want to look at all the different debt that you have and kind of figure out if you believe that the assets you were to invest in different vehicles can get a return that outpaces that interest rate.
All righty. We have another question here. I believe this will be for you, Catherine. There is talk floating around about new IC taxes and standards coming where ICs will be paying out astronomically in taxes. Do you have insight to this matter?
Actually, I am not going to speak on that. That is not something that I have expertise in.
Okay. No one? All right. Okay. All right. I will move on to the next question. Oh, this is really good. What are different ways that a millennial can use life insurance to help them become a millionaire?
You could put a $1 million life insurance policy on someone else and take them out. But a legal way, though.
I didn't want to say that.
Yeah. And once again, we're not recommending any of these specific strategies, right? I mean, life insurance there are permanent. So there's term life insurance policies where basically it's like car insurance. You pay it every single month. And if you end up dying while that policy is in place for between 10 and 30 years, then your loved ones get, a payment for that. And then there's permanent life insurance policies where each month you may owe a premium of call it $500. $200 may go towards covering your life insurance, and $300 each month goes towards accumulating cash value. And that cash value can then grow over time as you continue to make those premiums, be invested and grow for you. So, having life insurance, that permanent life insurance policy as an investment policy or as an investment opportunity can work. But I typically recommend clients maximizing all the other tax efficient ways to save first and then utilizing it. But, I'm more than happy to go kind of in more detail about kind of the pros and cons of permanent insurance policies in someone's plan, offline.
Next question we have is, should only an attorney prepare a will or a trust for a person, or can it be done by someone else?
Okay, so the answer, okay, so technically, yes, sometimes people do their own estate plan. Sometimes they go to a financial person and get their estate plan done. But if you recall from the very beginning, from the beginning of the presentation, I mentioned that I had to do estate planning, but I also do administration and litigation concerning estates. And I've litigated so many estate plans that were not done by an attorney. Some are done by an attorney. Those are higher level issues oftentimes, but the mistakes and the issues generally a lot of the times do come from these plans that aren't done by an attorney. Now I just gave you the audience and everyone information, right? So you kind of know the components of an estate plan, but you don't know how the law reacts to certain things. You don't know if, how certain assets, react or are affected when you transfer them. So you definitely want to have an attorney do your estate plan, because they know a trust and estates attorney too. You don't want a personal injury attorney doing your trust and your estate plan. Someone that knows the law and keeps up with the law, because the law, especially in this field, is ever changing with the tax laws, just the laws in general. So you definitely want to have an attorney do your estate plan, but you can do it yourself technically, but I'm not saying to do that. Your beneficiaries may be in court one day. So not legal advice, but I would say definitely meet with an attorney one-on-one.
All righty. Next question is for Justin. For retiree, do you still recommend having 3 to 6 months of living expenses in cash?
No, I would typically have a higher buffer. So typically, when I advise people that are retired that are now living off of their investments and living off of their cash, we typically have a minimum 1 year of cash reserves, right? So $5,000 a month that's $60,000 a year. That will be in cash, and then we'll be investing the rest, right? And the reason why is that we want to make sure that, hey, if your investment account drops by 20% because the market is down by 25%, that we're now going to be able to use cash to push us through the next year as we wait for your investments to recover. So that's how we typically do it. And then, when you're retired, the worst thing you can possibly do is pull from your investment account after a big market drop. So what I typically recommend is, as we start spending down their assets, when there's really good years like this year, the U.S. stock market is up by like 25%. So if I have a client that we're starting to kind of run a little bit low on their available cash, maybe it's only at 10 months reserves when it was at 12 months, I'll probably make a distribution now that market's up by 25% and pull another 3 to 6 months of cash on the side to say, hey, let's lock in these gains and buffer us from any type of short-term volatility going forward. So if you're retired, look at your accounts in two veins: your investment account that's meant to grow to keep up in pace with inflation and purchasing power, stuff like that, and then cash for your short-term needs. Try to always have a year's worth of cash in short-term needs. As you start spending that down, bring assets over from the investment side at an opportune time during times of good market conditions.
All righty. Next question is, I have a significant amount of tax debt that I would possibly be paying for which will fill the remainder of my life. Does this have an effect on me buying a home? I currently have a setup with the IRS where I am paying the minimum. What do you recommend doing to knock this debt out?
So I'm going to say something before Justin. It's not really a tax question, but debt with the IRS, the interest rate is so low. You need to do, like Justin said, look at any other debt that you have, credit card debt, anything that's, you're paying a much higher interest rate. You want to make sure to get those things taken care of first. And then Justin, I don't know if you want to say something about buying a home and the type of things that they look at, what banks look like or look at.
Yeah, I would just look at different lenders. If you work at a big bank, right, like a Merrill Lynch, like a Bank of America, Wells Fargo, they typically are more strict with who they're willing to lend to for like a mortgage standpoint. Like for Bank of America, you have to have over, I believe, a 680 credit score to be able to buy a property through us. But some some credit unions, stuff like that, which offer also great interest rates for, a lot of types of loans. Their minimum credit score are much lower, like in like the low 600s, I believe. So I would recommend, first of all, you want to understand what your credit is, and I would talk to different lenders at different institutions to see if you're in a position from a credit score standpoint to be able to qualify for a loan. And if you're not able to, work on trying to develop that, to build that by paying off loans. And there's actually there's attorneys that focus on like credit repair, and they'll run your credit, they'll run your credit report and advise you on what you could pay off or what you could dispute, which will provide the most value in you increasing your credit score, and will work with you hand in hand in that process. And I did that. I advised a client to do that and increase the score by like 60 points in like 2 months. So look to those types of resources as well if you need to.
All righty. Our next question is it a good idea to consider having a fixed income annuity to generate guaranteed income for a retiree?
So an annuity is an insurance product. So basically, instead of you taking on the investment risk, the financial institution is taking on the investment risk, and you're getting like a fixed payment. So anytime that you purchase an insurance, whether it's a life insurance or an annuity, you're giving up upside for a guaranteed payment. So if you really want that fixed income and want that for a fact that beginning age 55 or 65, you're going to get paid X amount every single year without fail to the day that you die, then it makes sense having it, but I would never recommend putting all of your assets in annuity. It makes sense putting a portion of it, and I'd talk with a financial planner to be able to understand kind of what that portion should be, to be able to get that. But once again, don't put all your eggs in one basket, even if that basket is an insurance product, especially if that basket is an insurance product, I should say.
All righty. That concludes our Q&A. You all did an amazing job. What's the best way for people to get in contact with you all?
You can just, my name is Kevin Bryce Jackson. I'm at Freeman and Smiley in Century City. That's Los Angeles. And the website is ffslaw.com. And so you can find me there. My information's on the website. Again, ffslaw.com. Freeman and Smiley, Kevin Jackson. And so you can, anyone can give me a call, and I'm happy to either help you or refer you to someone that's a fit for you. So.
And then for me, you can find me on LinkedIn, or you can go to our website at worldmgmt.net, and it has all of our information there.
And Justin?
Yeah, for me, you can find me on LinkedIn or the website. You can type in Justin Lacy, Merrill Lynch. I guarantee I'll be the only black face that comes up. And you can shoot me a message directly through my website or through LinkedIn.
All righty. Well, let's give it up some virtual hands. I know we can't see each other, but yes, amazing job, you all. And I will now turn it over to Mr. Michael Lawson.
Thank you and good evening. My name is Michael Anderson Lawson, and this has been a wonderful evening and a wonderful end of this season's BWARP, the program. I'm the president and CEO of the Los Angeles Urban League. And on behalf of the Los Angeles Urban League and Parkside Economic Development Corporation, I thank you for participating in tonight's Black Wealth Attainment and Retention Program. We hope that each of you was able to benefit from our series of the importance of Black wealth attainment and retention. I want to thank Reverend Gerald Smith, Chairman of Parkside Economic Development Corporation, and Brian Williams, the Chief Operating Officer of the Los Angeles Urban League, for their leadership presenting BWARP, as we finally called this webinar series. I also want to thank the staffs of the Los Angeles Urban League and Parkside Economic Development Corporation for their diligent work on the webinars. Thank you, Jacinda Moulton, for your producing BWARP and your just keeping everything moving the way it should. I also want to thank my team members, Michael Rodriguez and Ron Carter, for your commitment to marketing the BWARP series. We also thank the local Los Angeles media for assisting us with marketing the BWARP webinars. Last and certainly not least, I thank all the presenters who did an excellent job with their thought-provoking talks, ideas, and discussions over the last year. They shared their knowledge of wealth attainment and retention with you, for you as well. Hopefully it was as valuable to you as it was for me. 2021 has meant something different for each of us, but one thing has remained constant. The Los Angeles Urban League and our partners' commitment to deliver quality programs and services to underserved communities. We trust that you'll join us next year while we roll out another series of resourceful Black wealth retainment and retention programs. We also hope that the information that was shared with you will contribute to your success in building intergenerational wealth for your families and our community. As the Los Angeles Urban League celebrates our centennial, please know that our mission is nothing less than rebuilding Black Wall Street here in Los Angeles. We hope that you will join us in this ambitious and timely mission. With this year coming to an end, we're excited to sow seeds of success for the next year. Our Centennial Gala is scheduled for April 7th, 2022, and is one such seed, and BWARP is another. Next year, we plan on having a more robust schedule of BWARP webinars. Please stay tuned for more information. It has been a privilege and an honor to be a part of these programs. Please continue to check our website for future information at www.laul.org. for information on the work that we're going to be doing and the services that we are providing. Again, thank you for attending our BWARP webinars. We look forward to hosting you in 2022. And thank you again, and good night.